Hello, good afternoon. I'm Phil Lloyd from NatWest Markets, and myself and my colleague Luke Ashman-Smith from NatWest will be giving you a bit of insight, but really it'll be less about us from the bank's perspective, but more about our illustrious panel of corporates who are going to give their clarity and insight on different stages of LIBOR transitions. We've only got 6 months to go between now and Christmas, but also now and the end of LIBOR. And actually, from a clarity perspective, there's a lot we have now. 18 months ago, we didn't know when it's going to end. We didn't know whether there'd be a term rate. We didn't know what the fallbacks would be, and all of that is now clear. However, you do all have some options, and therefore some difficult decisions to make. So, do you do nothing? Do you rely on fallbacks, or do you actively transition? And each of those paths have various things to consider. So, as I said, less about me, and I'm going to just allow Luke to spend some time with, we've got Sean from ABP, Natasha from Tesco's, and Sam from Hitachi Capital UK. So, Luke, I'll hand over to you, and then we'll probably come back to some questions from the audience. So please get your thinking caps on. Luke.
Brilliant. Thanks, Phil, and hi, everyone. So, as Phil says, we've got a great panel today. But just before we get into the questions, I'd just like me to spend a minute talking through the background and what their experience of LIBOR transition has been. So if we go, let's go alphabetically. So Natasha, then Sam, then Sean, please.
Hi everyone, so I'm Natasha Vowles and I'm the Head of Treasury for Funding at Tesco. LIBOR transition has been a challenge for all of us in the Tesco Treasury team, but my particular area of focus was the refinancing of our RCF using risk-free rates from day one, which we executed last year.
Hi, so I'm Sam Robinson. I'm the Deputy Treasurer at Hitachi Capital UK. I look after our issuance and debt capital markets, funding from the banks, and hedging our interest rate and FX exposure with derivatives. So I've attended the Bank of England's corporate risk-free working groups, and I'm currently managing a project to transition away from sterling LIBOR by the end of this year.
Hi, I'm Sean Kennedy, Group Treasurer at Associated British Ports. We've got quite an extensive exposure to LIBOR across a whole range of different products, from derivatives, bonds, loans, and US private placements. We've been looking at the LIBOR transition since around 2017 and started to transition since 2018 and still hard at it.
Brilliant. Thanks, everyone. I think that really demonstrates how much value people should get from this session. So thank you. So first question then for Sean. As you said, you started very early compared to nearly everyone, given the volume you had to do. So reflecting on what you've learned and what you've got left to do, how are you thinking about the remainder of your transition, given what you know?
Yeah, I think for us, our overall approach hasn't really changed. We still see the risk of doing nothing to be greater and outweigh the risk of actually taking action, and especially early on in our transition, where we were perhaps feeling our way with market standards perhaps not yet in place, trying out new things, dealing with banks that weren't really active perhaps in the SONIA market as well. So it was a sort of a bit of an exploration, trying to transition a bond. So we transitioned a bond back in 2019 and sort of showed that could be done with a bit of effort from all parties involved, but made that happen. And I guess over that time, not actually in that sort of 3 or 4 year period, not a lot has actually changed for us. We're still I guess come full circle a bit on standards. A few different things were floated, but we're still doing 5-day lags with look backs and no observational shift. We've got a lot more certainty on those conventions though, especially across products, especially in loans as well, where it's taken perhaps quite a long time to get everyone on board and aligned on that front. That consistency and clarity is now there. So for us, I guess looking forward, it's trying to get the rest of what we want done. You know, our approach is very much to proactively transition everything. We have adopted the ISDA protocol as an additional fallback, but our intention remains to bilaterally renegotiate those. Yeah, not much else. Is, I guess, things like zero floors, probably something that came to the fore in the last sort of 12 months as well, because we hadn't done much on loans. So that clarity has helped. It's now just getting the work done, and there's still quite a bit to do.
Brilliant. Well, thanks, John. That's really helpful. And you mentioned the proactive versus the fallbacks. So maybe we go to Natasha now, and you took the approach to do a day one risk-free rate loan rather than a deferred switch, and also proactively amended your derivatives. So if you could just touch on why you took that approach, that would be really helpful, I think.
Certainly. So we have taken a pragmatic approach, either dealing with things as they needed refinancing or taking a product set in its entirety and dealing with it in one go. And in 2020, we set ourselves a challenge of not adding to our LIBOR exposure so that we could contain things and actively start transitioning. And so we, on the swaps, we wanted to make sure that we had a controlled and coordinated process rather than looking at it on a piecemeal basis. And that allowed us to sort of manage the process and the proposed changes in the margin on a consistent basis across the portfolio. And with our loan last year, we thought that by Q3 2020, we would be able to do a risk-free rate loan from day one. And although there weren't a lot of precedents for us to point to, we took a lot of, we were really pleased that a lot of our bank group was in the loans that had used switch mechanics. So we knew that a lot of our banking group would be well progressed with their LIBOR transition plans themselves. And that kind of gave us the impetus to know that we should be able to get it done. And another core principle for us was sort of recognizing that what we moved to in 2020 might not be the exact final state, but at least if we took a pragmatic approach and had something that worked, we would still be limiting our exposure to LIBOR and making sure that we weren't adding to our problem.
Thanks, Natasha. And I think it's fair to say that loan set a really helpful precedent for the market, gave a lot of people comfort, given it the large syndicated nature of it. So, but yeah, very helpful trade. Maybe Sam now, just to give us a slightly different perspective. I know that you've given us a huge amount of focus from personal experience. So, but you're taking a slightly different route in your transition. So it'd be really good to give that insight, please.
Yeah, thanks, Leek. So we've got exposure across our derivatives book, our MTNs or bonds from capital markets, and also our bank loans as well. And we've got sort of hundreds of exposures. So we're kind of looking at it piece by piece, and we really have sort of three key objectives. The first of those is to minimize any basis risk. So we really don't want the situation where we have some of those on 2-day shift and some of those on 5-day lag, ideally. The second key objective is looking to pay absolutely no fees to the banks. And hopefully that includes implicit market costs as well, if we're going to do something that's off kind of market standard or not in line with the default bank. And the third objective is to avoid manually having to input payments or calculate settlements with fairly short notice and burdening our operations team. So we're hoping the approach across all the different exposures and counterparties will be as closely matching as possible. For derivatives, we've obviously had some difficulty that the ISDA fallback currently has a 2-day shift in there, whereas the banks that we're speaking to would prefer a 5-day lag approach. And I think that's the same for our bondholders as well. So we're trying to manage that process and think about how we can ideally get the two to match. We've looked at some banks and they've said that all derivatives, derivative counterparties, they've come back and said, oh, well, if you want to do a 5-day lag approach, we'll have to do something off market and we'll have to offset that exposure in the market. So there'll be a small sort of bid ask price for doing that. When we've looked at it, it's not a huge cost, but versus the cost actually of potentially just accepting some basis risk, which sometimes might be in our favor and sometimes against, there's an argument that perhaps just accepting the basis is a better way to go. So we've been trying to weigh up all those different options and assess what the best way to go with that is. Very happy to say that NatWest have agreed that we can sign a sort of bilateral agreement that will be very much in line with the ISDA fallback, but will be on a 5-day lag basis. So we're hoping that the banks will follow suit, and that will be a key sort of way of solving this for us. I guess the most challenging area for us has been the bonds or the private placements, because we don't have a direct communication with the end investor like we do with our banks and our counterparties. And what we've seen is that there's 3 approaches that people have been taking with that. One of them is to leave it to the current fallbacks, which in our case are pretty insufficient. They say things like the coupon just reverts to a fixed rate. So I don't think the investors would be particularly happy with that. And it could cause some issues our end as well. The second approach is using a tender offer to repurchase those bonds. Again, we'd like to avoid doing that because we prefer to have certainty of our funding, and there could be some costs involved with that. And the third approach, which is our preferred, is to renegotiate that fallback. Luckily for us, most of our exposure is going to be in private placement, where there's only 1 or 2 investors, so we can use a written resolution for that. But if we have a syndicated bond, we'd have to go through essentially a consent solicitation process, which can involve having a full meeting and having a tabulation agent. So that's something obviously needs to be considered and could potentially be quite expensive.
Thanks, Sam. It's a great level of detail. And as I say, I think it's important to have that that contrast of not the proactive route is very relevant for a lot of people, but not for everyone. And some people will prefer fallback. So as Sam mentioned, we're really hopeful that this development that we've made and literally just got approved in the last week will be helpful for the market. As Sam says, the idea is to create a bespoke amendment agreement, which would be bilaterally executed between ourselves and a corporate customer that has a derivative which is hedging a loan. It would be exactly the same as the ISDA fallback, but with the difference being that the fallback is the 5-day lag reset rather than the 2-day observational shift. So if a corporate is going down the deferred switch route for their loan, then this would match that convention and remove the need to have any mismatch or do a renegotiation post cessation. We're just finalising documentation, so we're not quite there yet, but we should be able to roll it out in the coming weeks. As I say, not for everyone, because some people will be going down the proactive route, but hopefully helpful for those that aren't. We're not sure of other progress from other banks, but I would imagine that it would encourage other people to look at doing something similar. So watch this space. Maybe this is a good time just to pause and see if we have any questions from the audience. Phil, have we got anything?
Yeah, I've just got one question coming in here. So does anyone have any suggestions about how to transition intercompany loans? Are you moving to SONIA in arrears or something else? I don't know, Luke, is that maybe one for Natasha?
Yeah, I think that sounds good. If you're all right with that, Natasha.
Yeah, so we have just started moving our intercompany loans over to SONIA, and we are taking the approach that internally it is easier to fix in arrears, but we're using the SONIA 3-month swap rate to take that fixing, and it just makes it a bit easier for everybody to manage the process internally.
Interesting. Okay, so you would take at the end of the period, you would take the you'd take what the swap rate rather than the compounded daily fixing.
So I think we're looking at it at the start of the loan and then fixing it then. Just because operationally it's a bit cumbersome to do it at the end, and it just gives people certainty within the systems as to what's happening. Yeah, okay. So actually very similar to the term rate kind of proposal that's out there, but just using the swap rate rather than any like official term rate. Okay. Yeah, and we've also looked at embedding a credit adjustment spread within the margin that we're using internally as well. Interesting. Okay, that's interesting. And the credit adjustment spread, is that a similar credit adjustment spread to the ISDA fallback that you're thinking? Yeah. Okay.
Great, lovely, thank you. Phil, it looks like we've got a few more questions. What do you?
Yeah, well, Natasha's doing so well. We've got another direct question for you. So did you take the opportunity to reduce or streamline your swap portfolio, or was it just a straight switch one for you?
No, for us it was just a straight switch, but we coordinated that process at the same time so that we could make sure that the margins that were being changed were all on a consistent basis. But we didn't have sort of hundreds of derivatives to deal with. It was quite a contained portfolio that meant that we could do it that way.
Okay, understood. Thank you. And I've got another question here, which I'm going to chuck to Sam and to Sean, if that's all right, Luke. It's quite broad, so but interpret as you want. And just, our systems ready for transition? So I guess a bit of a sort of view on that would be helpful.
I
Sean?
jump in and go first, and then anyone else can add to that. From my point of view, our treasury management system provider is ready. I guess by starting early, we started our dialogue with them quite early on. But I talk to a lot of treasurers and understand people are still having challenges with systems, and our systems are still improving the way they can handle risk-free rates all the time. So it's definitely a work in progress, and there's more work to be done. But I think it's best to have input from treasurers in that process. So, you know, any dialogue you can have with your own systems providers is definitely a good idea. So that's our experience so far, anyway.
Yeah, I think relatively similar experience. I think our provider's been a bit slower, and I think they've rolled out sort of product by product the functionality for the new benchmark. So we've had it with the moment we're in a position where we can do it on, if we want a sterling SONIA loan or a SOFR linked loan or bond, that would be fine. That's something we can roll out. The same is true for interest rate swaps. It came a bit later, and next week they're rolling out the cross currency swap product. Unfortunately, they were not able to use the cross currency product for hedge accounting until a few months later, which means we are going to have to do some manual workarounds to basically sort of book like a LIBOR property trade on the system and use that for the valuation. Then hopefully when it's all sorted, we can delete that trade and designate that hedge. So it's sort of functional, but it's still a bit messy, unfortunately.
Thanks, Sam. Luke, hand over to you, Luke.
Sorry, yeah, thanks. I mean, that's interesting on the hedge account. That does sound messy, but hopefully there's a plan going forward. I'm just conscious there was the question on the intercompany loans, and we asked Natasha, but actually it was probably worth just checking whether Sam or Sean have had any different approaches, just to give a full picture.
We do have some. We're moving to a SONIA compounded in arrears as we're doing the rest of our treasury products for us.
Okay, interesting. And Sam, I'm not sure if that's anything you need to think about or not.
No, we don't currently have anything documented.
No, okay, thought it might be. Okay, thank you. Thanks, all. Maybe just sticking with the systems point, there's a specific question. How do you source the risk-free rates? Now, I imagine everybody on the panel will say through their treasury management system, but just check whether that's the case or if there's any other routes you're taking.
Yeah, I mean, we did that. We sourced it through the system, but we did sort of produce our own spreadsheet just to check we were happy with what the system was providing. And
I think it's probably worth saying that we do provide a sourcing through a website called realiserate.com, which if you just stick it into Google, it will come up. It's a very good site in terms of it's a lot of explanations, but I guess the key thing is it does provide the overnight rate fixings for all the main currencies, and you can also see what the compounded daily average is for any period that you like. If you're looking historically, if you register, then you can get access to daily, like today's rate by the Bank of England website as well. and that can be pulled into spreadsheets. So for those that don't have a treasury management system, that is an alternative. I mean, Phil, we've got more questions we've prepared, but it feels like we should answer the ones that are on the screen here. That's coming in thick and fast. So where do you want to go next?
Well, some great questions here. So, well, should we go to the difficult one, which has got the most thumbs up? Who's picking up the legal costs for LIBOR transition? A, the funder, and B, or B, the borrower. So, Luke, who's maybe one for you, Luke, if that's allowed.
I think we'll see if there's any differences in from the panel. Sean, you've done probably quite a few, so.
Yeah, I guess it depends, but certainly on when we did our bond transition, we picked up some fairly hefty legal costs there to go through a consent solicitation process. On the loans, we are, I think, in the round generally taking on the legal costs. It's up to the lender whether they're then seeking their own advice on that, and that will depend by financial counterparty, and then depend a bit on the loan if we're then going to pick up those costs as well. So worth talking about. I think in general the onus is, I'm finding in this transition, is very much on the corporate to be proactive, to be doing things, and therefore unfortunately incurring a fair bit of legal costs. We haven't incurred any on swaps. We've generally just done that ourselves within our swap confirmation, so that was perhaps a bit easier. But I guess one for probably each individual corporate and their financial counterparties to manage. But it does feel a little unfair to be put all onto the borrower in this instance.
Yeah, I mean, that's consistent with what we've seen across our bilateral loans. We've seen that it's been each party picks up their own legal costs, so you can choose whether you want to handle that for internal counsel or get external advice on that. And if you can avoid the consent solicitation, I think we have to pay for a written resolution to be produced, but it's quite a small light touch document.
Thanks both. And Natasha, you obviously did the syndicated facility. If you can share any insight on that fees wise.
No, I don't particularly have anything to add other than what's been said before, in that, you take the decision whether you want your own legal counsel, and lenders will decide what they want, and sometimes the borrower does pay for it, and other times it's up for negotiation.
Okay, thank you. Okay, well, maybe let's go on, Phil. Yeah.
Sorry, just one point. So you mentioned realiserate.com, but I would also add that there are a series of sort of indices or indexes now available, which I think ICE have produced. I don't know if the panel of either of you three have seen those or any views on those. I mean, certainly it's produced as a way to help the market have some sort of form of standardization. I'll open up to any of you if you've got views on that. Sam,
yeah, I mean, we've oh, sorry, do you want to go, Sean? Oh, okay. Yeah, I mean, we've looked at that in some of where we've had our interface directly with the customer, and it's been some of those areas where it's kind of hard to transition. We've been looking at those providers. We've had a bit of a kind of chicken egg situation that we don't know. We didn't want to redocument all of our loans to reference ICE, and then it turns out that ICE kind of gets discontinued, and another one of those term rates is the one that everyone sort of coalesces around. So I'd be interested to hear if anyone else has kind of taken the plunge on that. But I did notice the other day that ICE has now got a ticker on Bloomberg, the ICE term SONIA, and we've sort of made the assumption that based on it being the current provider of administrator of the LIBOR rates, that might be the one that gets adopted in the market.
Okay, thanks, Sam. So that's on the term rates, and those term rates, which are quite limited in how they can be used. What exposures are you planning to use the term rates for? I think that would be a helpful insight.
So for us, it's really going to be the sort of very difficult areas where we're facing a customer where they're not going to be able to kind of comprehend the idea of compounded SONIA rates, and we'll look at things like if there's an overdraft, if payments made and needs to be calculated overdraft costs or something like that, or if something like invoice factoring where you have to do discounting, it'll be areas like that.
Okay, thank you. Thanks. And on we have got a question on the indices as well, that Phil mentioned. So, and the question is, I've heard some people are using indices. How do these fit into the rest of the reference rates being offered? So maybe I'll just give a bit of background for people. So the daily compounded rates obviously can be calculated using treasury management system or things like realiserate.com. But there are now some indices which effectively do the calculation for you and mean that to find out what payment needs to be made for any given period, you can effectively just divide the index for this end of the period by this index at the start, and that will do the work for you. So it reduces the amount of operational work and risk, I guess. And so those indices are now being published by ICE. And so they can be referenced in contracts. There's obviously like a legal contract between the lender and ICE to use it, but they are available, and they've been used mostly in the bond market so far, because it makes the bond market probably a bit more simple. But we do expect them to start being used in loans as well. Sean, maybe given you've got a number of loans that you've done and upcoming, any thoughts on using indices instead of just the standard formula?
Yeah, I think the indices are a great way of simplifying things for people, and I think there are indices from ICE that cover things like 5-day lags without observational shifts as well. So you can match to the sorts of things that we're generally doing as corporates. We're not planning to use them. We're just going to stick to referencing SONIA directly as a risk-free rate and compounding that. We're quite comfortable with how that works. Ultimately, if you did have an index, you'd probably have a fallback in your documentation if that index provider disappeared or wasn't able to put up a screen rate to the base underlying rate and formula in any event. So as we're comfortable with that, we're probably going to avoid the indices, but I certainly do see them as a way of just making it easier to access SONIA compounded rates, because it removes a lot of the more complex documentation or wording issues around that. Yeah, makes everyone's life a bit easier. I think there's probably indices with zero flaws as well, I think, if I'm correct, daily four. So that there's sort of an index out there that should meet most people's needs.
Yeah, that's correct. Yeah, that's right. Good, thanks, Sean. Phil, should we go for this? There's one with 3 thumbs up, so that looks like a good one to be going for.
Sure. Yes, this is the approach to multi-currency facilities. I think it's no secret that obviously the US is on a slightly different path and with the June 23, and so obviously while sterling's the path's pretty clear, the dollar market's still in a bit of flux, and then obviously in Europe you've got Euribor staying for foreseeable future. So I don't know who wants to take this one, Luke, but any experience of multi-currency facilities, in particular with regards to dollar LIBOR exposure? I don't know who that's relevant for.
Natasha, I think I'm right in saying your facility was SONIA and SOFR. Is that I've got that right?
Yes, that's correct. And when we did the facility last year, we took the approach of having different credit adjustment spreads for the different currencies. And we built that in, and we also maintained the flexibility to have multiple interest periods. So we've got different credit adjustment spreads depending on the currency and the interest period itself. Over time, you won't need to have that credit adjustment spread table because it will just get baked into the margin. But it was the sort of pragmatic next step that we were able to take last year to deal with the 2 different currencies.
Brilliant. Thanks, Natasha. I'm sure that's answered the question, so thank you for that. There's another question which maybe I'll try and give it a go. So it's got 4 thumbs up now. So what is your experience for the IBOR risk adjustment premium on loans and derivatives? So maybe it's related to what Natasha just mentioned. So there's different routes that you can take for transitioning. You can either go down the proactive route, where you, whether it's on a loan or a derivative, where you effectively look at the implied difference, the market implied difference between the LIBOR and the risk-free rate for the remaining period of the loan or derivative. Using the same methodology, the derivative will be based on like a mark-to-market, and the loan is kind of using a very similar method, just based on interpolation. The other method is to go down the fallback route, where you effectively say you're going to carry on with LIBOR until the end of LIBOR, and then it will move to the risk-free rate. For a derivative, that's using the ISDA protocol, and so there are some credit adjustment spreads that have already been set. They're based on the historic median, 5-year median difference between LIBOR and the risk-free rate as of, I think it was the 5th of March this year. So those are locked in and known now. Those numbers are slightly different to what they are for the implied forward difference, because as you can imagine, the forward implied is basically factoring in what's going to happen from the 31st of December, which is the fallback one. So you've got this difference in periods between now and then. But as we get closer to the end of LIBOR, at the end of this year, those numbers are getting closer and closer together. And that's effectively the same for loans, the same for swaps. So they can be made to match, but you do need to decide which route you're going down, and that will impact on what those credit adjustment spreads are. So they're commonly called CAS, credit adjustment spreads. I think probably that's the limit of the detail we can go on this call, but if anybody does have any other questions on that topic, I think please reach out to your lender, and we're happy to talk. There's another question here which I think Phil and I won't have any experience on. So can you explain a little more on the expected middle office and finance impacts, how valuations and interest accruals are affected? I mean, it's quite a technical question, but I think maybe if one of the panel could just give a bit of a colour on how they've been working with finance teams around how to manage the transition, maybe that would be a helpful insight.
If I'll jump in first and then let someone else talk. I think for us, interest accruals was an interesting one. It sounds really simple, but going from knowing your interest cost at the start of the period to having it change every day, and know it at the end was a fundamental change to the way we accrued interest, and therefore a fundamental change in how ultimately how we had to set it up within the system provider. So that comes from the systems, but it was it's been a big change for us that we've had to deal with, but we've dealt with it through the system. I think if you don't use a system, then that brings in new challenges that you'll need to work through. So I think it's probably something that I took for granted a few years back has been fairly straightforward, and it's probably not. We've had less of an issue around valuations. We already discount our derivative valuations using the OIS curve, which is the SONIA-based curve. We moved to that some time ago. But I guess if you're discounting using a LIBOR curve, that's going to change as well.
Thanks, Sean. Sam or Natasha, did you have anything to add to that?
I guess similarly, we haven't really seen a huge problem with the valuations. I guess the accruals, the one thing to consider is that previously you have, like Sean said, you've locked in the costs for the whole 3 months, and you've now got a sort of non-linear approach to allocating that interest. And obviously, if you're in a situation where you start to expect a rate increase, you potentially are understating your interest cost, and that has to be factored in if you're sort of forecasting or communicating to the business what the interest will be for from now, say, until the end of the year or something like that. There's potentially some additional calculations you need to do.
Yeah, that's something that we've definitely heard people voice maybe concerns or they've definitely had to think about it a lot in terms of budgeting. That's right. So it is possible to do a short dated hedge if there was really an issue in terms of forecasting. You could do like a 3-month swap, for example, to lock in the SONIA fixings if you haven't already got a longer term hedge. But obviously that does bring more operational work, but it is possible if somebody did want to lock that in. There's a question here which maybe if we go to Sean, because he did mention it, that the mention of floors on the call. Recently, we've had a request for a daily floor in the loan agreement. I wondered what the panel's experience was. So Sean, you just mentioned that, so let you take that one.
Yeah, I mean, floors are ultimately a commercial discussion between you and your lender, and what I guess any lender will look at that as the overall, as part of the overall return they're making on a loan and the risk that they're taking with that. And so, you know, floors are not necessarily guaranteed, but I guess within this low interest rate environment, certainly I think most lenders are pushing for them, and most of our loans or debt agreements have some sort of floor in it. So we already have that established even in the LIBOR world. The recommendation from the working group on loans, and you don't have to necessarily follow it, but the standard that's recommended has a daily SONIA floor. If you've got a credit adjustment spread, that might be incorporated as well, so something to take into account. But ultimately, it's a commercial discussion for you to have, and something you need to think about. But when you go into any new negotiation.
Thanks, Sean. I think the one point I just make add to that is that the derivative market, the standard floor in the standard, say, SONIA floor in the derivative market is not a daily floor. It's a compounded floor, so it floors effectively just the payment, so the compounded rate at the end. It is possible to do a daily floor, but it's less liquid and more expensive. So if you've got a loan with a floor and you're looking to swap that loan to fixed and want to effectively buy the floor back through the derivative, then that's something to take into account. And as Sean says, it is a commercial discussion. And so whilst the recommendation is there for a daily floor, it's something to be discussed with your bank to see whether there are any alternatives there for you to explore.
I imagine it's quite valuable at the moment as well, daily zero floors. Certainly the most valuable from a lender perspective, so don't give it up lightly if you're a corporate.
Exactly. Thank you, Sean. Good.
Sorry, I'm not handing out advice. I'm not qualified. I'm not registered with the FCA. That's just a personal view.
I think that's very clear. That's good. Good. I'm conscious of time. We had 40 minutes and we're at 38. So I think we have covered the majority of the questions. There are still more, so I'll cover everything. But Phil, maybe I'll hand back to you just to try and summarise where we've got to there.
Sure, although I'm going to put it straight back to our illustrious panels here to Sean, Natasha, Sam, 20 seconds each on final words of wisdom to our corporates here. Sean?
I would sit down and decide early on, decide now exactly what it is you want, what works for you before you start engaging with any financial counterparties. Just be very clear what's right for you.
Natasha?
I would absolutely echo that and add that internal engagement is really important to make sure everybody else who's affected by LIBOR transition understands what you're doing and what you intend to do and how it will impact them.
Thank you. And Sam?
Yeah, very similar message, really. I mean, if you haven't done it already, go through and assess what exposure you have, what's a need to have, what's a nice to have, and get a clear message if you haven't already from your systems provider about when they're going to have what you need in place and when you can start this process, and don't leave it all to the last minute.
Yeah, thanks, guys. And I just sitting on some of the main RFO working groups, the Q3 milestone about active transition. I mean, that is really a nod to don't wait until December. Crack on now. I think it was all the panelists have said there's some real complexities front to back. So give yourself enough time and speak to Luke and the team at NatWest around the fallback alignment. That's a solution to help your path. Although obviously we encourage active transition. I want to say thank you to my colleague Luke, to Sean, Natasha, and Sam, and obviously Luke and I welcome further conversations, and I really appreciate the insight and wisdom of the panelists. So thank you very much.